Well, I think we're still a very cautious house at the current time. We still think there's a lot of risks out there. Clearly the rise in oil price will just exacerbate the downside risk for what is a fragile corporate environment globally. So we're worried that you will get a US recession this year. There will be a global slowdown taking place, and that equities that have discounted this massive V-shaped recovery now are going to be full of disappointment for investors. So we're still saying stick with bonds, and it's a very testing environment, we would argue.
Obviously, the Iran story has raised the spectre of escalation, and the oil price rising modestly here begins to raise some concerns around the direction of energy costs and inflation, tax on the global economy, and so on and so forth. But I still think, and I've been floating this morning, that there is a bit of FOMO left over from 2019, that people are licking their wounds from the fact that they didn't participate in that 25 to 30% upside that we saw in US equities.
Yeah, and absolutely. I think from our point of view, we've been cautious, particularly in that latter part, so we got it completely wrong in terms of the market. But, and you have got people saying, look, there is no alternative. So the two phrases that are critical here are TINA, there is no alternative given the level of interest rates, and FOMO, that fear of missing out, as you say, Jeff. Now, we saw this play before 2017, the end of 2017, going into early 2018. Global equities are still 7% down on average. The average global equity is down 7% from that peak in 2018, and US equities are down 6%, taking the median value. So, the headline gives you a very different story to what's going on for active managers here, and they've been having a pretty tough time.
I want to talk about the type of 2020 narrative that we've got around geopolitics, because it was a big feature for 2019. There is an element of, we have seen this script before, trade tensions and tariffs in 2019. Now we've subbed out a common enemy being China and replaced it with Iran, and geopolitical tensions are back, which we've also seen before. Doesn't mean it's any easier to trade. What do you make of this change of focus away from China to the Middle East? Well,
I think the change in focus from China to the Middle East tends to be quite temporary, Karen, I would argue. You can explain almost 80% of global equity moves by developments in our China activity tracker. So really the big implication will be, what happens because of that oil price going up on Asian trade. And you're looking already, we had some weak Chinese numbers out this morning. We think there's very little monetary stimulus coming out of China at the current time. You're not going to get that big boost to global growth from either monetary stimulus or from trade. Remember that phase one trade deal, it only takes trade tariffs down 1%. 64% of all trade is still being tariffed at 25%.
Because one of the strong calls out there has been that emerging markets are going to have that moment in 2020. What you're saying then with this oil price story, that is not
the only thing that drives the emerging market for a long run strategist is the dollar. So you have to have a very negative dollar view if you want to have a big emerging market rally. And that can only really happen if you get very, very weak economic growth relative to the rest of the world, or inflation in America picking up much faster than the rest of the world. And in a world where you get economic weakness, recession, and political uncertainty, where the equity risk premium goes up, typically the dollar tends to do pretty well because people head back to US Treasuries.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.